Hey guys, welcome back. Joe here from 9 to 5ers, and we're going to be talking about the differences between a traditional IRA and a Roth IRA. There are some differences to each one of them if you're completely new to it, and which one should you be investing in? Because the answer is not one or the other. It depends on your situation. So let's just see if we can't answer some of these questions for you guys and hopefully give you some action points here at the end. So quick disclosure here, guys, just remember that I'm not a financial advisor or any of the above things you see on here. If you need some financial advice, seek out professional advice on an as-needed basis and make sure whoever you're getting it from is credited and trusted. Thanks. Let's move on. So a quick overview of what we're going to be talking about here is going to be the traditional IRA. What is that? And then we're going to talk about the Roth IRA, and we're going to compare and contrast the two of them so that you kind of have an apples to apples comparison here. And then we are going to figure out some exit strategies for what you should be doing. And then, all right, what should I do with this information? So without further ado, let's just jump right into it here. So a traditional IRA, also known as a 401k, these are kind of the same thing, but if you have a 401k with your work, it's generally a traditional IRA. And what this means is that you can contribute up to $19,000 per year, and this is bumped up on a yearly basis, and this is set by the federal government. So if you ask your employer or your accountant, they can give you whatever the current number is. By the time you watch this, it might not be $19,000 anymore. When you contribute to a 401k, you get the tax write-off now. So what we're saying here is that if you make $100,000 a year and you contribute $10,000 to your traditional IRA or your 401k, you will only be taxed at a $90,000 tax bracket, even though you made $100,000 that year. So that's nice. You're kind of getting the best of both worlds at the same time there. And you will be paying taxes upon withdrawal. When you're ready to take money out of it and live off of that income, then you're going to get taxed on the contributions that you put in and also the profits that you made throughout the life cycle of the product. And some important dates to look at here: when you turn 59 and a half, you can pull out any and all of what you've earned from that, but anything before that, you're going to get penalized. And then at the age of 70 and a half, there are what's called forced withdrawals, and it's based on a percentage of how much your total portfolio is worth. So it's not going to be a set dollar amount for each individual person. If you have $100,000 in yours and someone else has $200,000, that person's going to have to pay out, take out more, but it's based off of a percentage of what your portfolio is. And of course, those will be taxed, the contributions and the profits that you pull out there. So, and generally, if you have an employer and you work if you have a W-2 income, the employer usually does some sort of match as an incentive to work for their company as a perk or whatever. Early withdrawals. If you pulled out money out of your 401k before the age of 59 and a half, you will get taxed as if it was regular income. So you would be at that higher tax bracket, and then also a 10% penalty, and that is painful. There are instances, and this depends on your situation or the way that yours is set up, but you can borrow the money from yourself, and you have to pay an interest rate back, but that interest rate does go to you, not to the government or the custodian that's holding your portfolio itself. But that's kind of more of just a caveat, and you kind of have to look into that in the specific situations. But so early withdrawal, as in if you're pulling the money out and not planning on paying it back, you're taking the actual cash out. There are situations where you can do a loan against your 401k there. So they are a little bit different situations. So a Roth IRA, you'll see this number right at the beginning is much lower. Contribute up to $6,000 per year, and this is bumped up on a yearly basis by the federal government. And by the time you watch this video, it might not be $6,000 anymore, but you can find that out pretty easy what the max is just by doing a quick Google search. The money is taxed when it goes in. So this is the opposite of a traditional IRA. Your money is if you were going to contribute to a Roth IRA, you would get your paycheck, you would take it home, you cash it at a bank, and then you would take that money and then put it into the Roth IRA versus it going in when you before you got your check cashed. And then the great thing about the Roth IRA is that the withdrawals are tax-free upon when you decide to pull the money out, and this is contributions and profits, which is great for saving on the taxes down the road. Some important dates here to look at is you can pull out the principal on an as-needed basis because the money's already been taxed and you don't have to worry about a penalty, but you cannot take out the profits before the age of 59 and a half. And the 59 and a half follows the same concept as the traditional IRA, but you can pull out the principal now if needed. So you got some flexibility there, which is great. And employer match is rare. I don't know of any employers that do this. You might have one, and that would be great. But I've never worked for an employer that did a Roth IRA match. And earlier withdrawal of profits. Notice that says profits there. That's you would get penalized on the income tax. You get penalized 10%, and then you would also get a regular income tax rate, which is pretty nasty, and that can potentially be painful. So if you had, let's say you had $6,000 in your Roth IRA and it gained $1,000 of profit in a year, and you pulled out all $7,000, well, the first $6,000 would just come out, and that wouldn't be penalized or taxed. And then the $1,000 that you did pull out that was profit, and you're under the age of 59 and a half, you would get slammed with income tax, regular income tax, and 10%. And I'm saying regular income tax on this because they would look at it as if it was earned income, and you would be at a higher tax bracket versus a capital gains tax, which is much lower. So let's compare the two here and just to kind of do a summary to make sure that we are on the same page of the differences between the two and how they are similar, because they are similar in a few ways. So traditional IRA, you can put up to $19,000 a year, and once again, this is upped every year by the federal government. The Roth IRA, unfortunately, you can only put in $6,000 per year, and this is taxed upon withdrawal for the traditional IRA, and this is taxed as it goes in. So it's just flip-flop, basically. Super easy to remember. And then 59 and a half is the earliest you can pull out anything at all for the traditional IRA. And then 59 and a half is the earliest you can pull out profit, and that's the profit only, but you can pull out the principal on an as-needed basis. Hopefully you don't have to, but that is the option that you have there. Number 4, employer match, like we talked about. Most employers will do this to certain varying degrees of matching there, which is great. That's free money, so to speak. And then the Roth, it's rarely happens. So this is kind of like more of a either do it on your own type of situation to put that in there. And 70 years and a half, there are mandatory contributions, which means you have to pull out that money from your account, that whatever you contributed, there's a certain percentage of that you're going to have to pull out from there, and that will be taxed. The tax man wants their money, and they don't want to wait around for it. And the reason why there's no mandatory contributions to pull out at the Roth IRA level is because they already got paid their taxes, and they don't care what you do with it. So no big deal. So what do you do? What should I do? I don't know what I should do. I know the differences now, but what should I do? So generally, if you want to do a Roth, it's you would be maybe more you're younger and you cannot max out your 401k. You got a little bit of excess income, but not much, but you can't afford to pull out the full 19,000 there. And you're in a low tax bracket. So if you're in the lowest tax bracket, you're not going to really be helping yourself by taking that tax sheltered money out. A great thing about the 401k is if you're in a really high tax bracket, you could potentially lower to another tax bracket if you take out enough money. And you don't, and let's say you're working in a job where there's no employer match option available, like they're just not helping you out. What would you do if you thought the 401k was a better idea? You can max out your 401k amount. You can max out that 19,000 plus a year. You are at a higher tax bracket than you will be when you retire. So if you are in your prime earning years of your life, and you're thinking to yourself, when I retire, I'm not going to have any debts, or I'm not going to be having as many expenses, then you would contribute to a 401k here, because this is you're in a higher tax bracket, and you want to shelter that money as much as you possibly can now. And you have access to an employer match. So some takeaways, what should you kind of be doing right now? Well, do something. Investing in either one of these is going to be better than not doing anything at all. And if you're really, really young and you kind of fall into that left category there of what you should do, start with the Roth. And you're not making a lot of money, just start with something. And then maybe as you get older, or you move into, you find an employer that's willing to do a match, and you start to move up in tax brackets and income, which is of course a good thing. You could switch to a 401k. That doesn't necessarily mean that you have to not fund your Roth IRA, or get rid of it. You're more than welcome to just let it sit there and earn interest on what you have in there already. You don't have to contribute to it. So you could have potentially both. And another thing is, remember that when you're getting closer to the age of retirement, pay off all that excess debt that you might have, so that you can lower your expenses, and you have to pull out less and less of your Roth IRA or your 401k, and you can keep as much of that money in there as you possibly can working for you. So guys, what do you think about this video? Did this make sense? Do you understand the difference between a Roth IRA and a 401k? Did we answer all of your questions? What stopped you in the past from reaching your financial goals? Let us know what your feelings are about the 401k and the Roth IRA in the comments below. And what types of videos would you like to see next? Please like, comment, subscribe, and check us out on Facebook, 9 to 5ers. Like us and follow us. We really appreciate it. And we are here to make you smarter today and richer tomorrow. Have a good one, guys.